to spend the other $4 every month on our credit card. This is a grand scheme that works for a little while, and then eventually you run up against the fact that your minimum payments on your credit card exceed the amount of income that you have, and the game's over. What the government has essentially tried to do is step in and take over that borrowing function, and where Bernanke has blown this, and this has been something I've been consistent on since I started writing about this in 2007, is he has said that this is a short-term stimulative action taken by the Federal Reserve and, of course, in concert with the federal government. But that short-term stimulative action, in order for it to work, would have to return to the ever-declining value of actual output as opposed to new credit in the economy to support GDP. And that hasn't happened. So we're 4 years into this now. The grand experiment has failed consecutively for 4 years. And the only thing that has happened is we have driven speculative hot money flows into things like oil, gold, silver, and stocks. And yet, when you look at the actual underlying amount of money available in the economy, the actual output and production, it's just not there. We have, at this point, we have something like 1 out of every 3 consumptive dollars that are being spent by Americans are coming from federal government transfers. And 43% of everything the federal government spends, it's borrowing. So this is not a sustainable situation, and the alleged shift back to the private economy that was supposed to happen 2 years ago hasn't.
So what we've really got is a shift of wealth and income from the real economy over into the financial economy, and it is only those people truly related to the financial economy that are seeing the beneficial impacts of Ben Bernanke's policies?
Well, I wouldn't even say that it's just the beneficial impacts. There are real negative impacts that are being served up on average Americans. The prudent, reasonable retiree, for example, that has a fairly large chunk of cash saved, that was making out okay off the interest on certificates of deposit, for example, has been forced into dangerous and risky speculative actions in order to get anything at all. There's no interest income available today off of that. A couple of years ago, on a 5% basis, you could have a $50,000 income, federal tax-free, by investing $1 million in municipal debt. This was a reasonable way to live, and a lot of people did this. Now that same sort of investment, if you have it in a certificate of deposit, earns 0.25%, which is $2,500. There's no way you can survive on that. You'll be eating cardboard. So we've taken the hot money flows and put this risk trade into the economy, so to speak. But for those people that are not desiring to risk losing everything they have, this has been an absolute disaster.
Yeah, no, I understand that completely as I try to keep my mother on her savings in her retirement years from having to go eat beanie weenies for dinner every night. It's quite a bit of a challenge. For the next question, we're going to turn to our member Thor. Thor?
Hi, Carl. Thanks for joining us.
Hi.
Do you see any risk of either a currency crisis in the U.S. dollar or a default on the treasuries? And if so, what do you see as an end-game scenario?
I think there is some risk associated with this kind of an event, but it's going to come from inaction rather than action here in the United States. We currently have a big debate going on, as I'm sure everyone's aware, about the debt ceiling, and both Democrats and Republicans are making all kinds of noise, and people are issuing threats. Geithner is running around along with others. And the reality of the situation is we have to stop doing that. S&P has kind of thrown the gauntlet down, and they're absolutely correct. They've said that not only do we have to have a plan out there now, but we have to implement it by 2013. Well, that's the first budgetary year after the 2012 elections. So we don't have time to screw around with this thing and wait until after the 2012 elections. Then we'll figure out what to do, which is what everybody likes to do. Okay, politicians are always interested in making sure they get reelected first. Then they'll talk about whatever it is that they want to talk about. S&P has made clear that that's not an acceptable path because it's what we've been doing for the last 4 or 5 years. It's just kicking the can and, let's look down the road a ways and we'll deal with it then. What I see as a real possibility is that if we have a situation develop where the international community, especially the Saudis and the Chinese, were to decide that they did not trust the ability of our government to get its act together in regards to deficit spending, and that we were just going to continue to QE until the cows came home, that the likely reaction at some point is for the Saudis to say, okay, we're not going to sell oil in dollars anymore. We're going to demand something else. And that something else could be renminbis, it could be euros, it could be anything. You could also have the Chinese turn around and start selling these things. I think there's a non-zero risk of that sort of thing occurring. What has kept people in check thus far is the fact that if you're the Chinese and you're sitting on $3 trillion in U.S. assets and you blow up the world, your $3 trillion goes up in smoke. So, there's kind of a Mexican standoff here where everybody's pointing guns at each other, but nobody dares shoot. The shorter term horizon problem that I see coming, that I don't think we're going to avoid, is the Japanese situation. For the last 15 years or so, the Japanese have had an economic model where they bring goods and services into their country, they manufacture things, and they turn around and spit them out, and essentially take the difference as a means of financing their deficits. That's a very clever little plan, and it's worked for a long period of time. It started in the 70s, but really got cranking after the lost decade got going over in Japan, and it's how they managed to pull this off and not have it come down around their ears. They've now got a problem because they need to rebuild after this earthquake and tsunami, and that means that goods and services are going to go into Japan but not come back out. That is going to shift trade balances and trade flows. It is totally being ignored right now by everybody on the international stage. That is a huge mistake. Right now they are busy clearing away the wreckage and figuring out how many people are dead. But sometime in the next 6 months, they're going to start putting their effort towards rebuilding their country, as they must and as they should. And when they do, these trade balance flows are going to shift. And that's something that has the potential to be extraordinarily disruptive. And I see nobody paying attention to it. I think the United States has to have its act together with a concrete plan to deal with these issues before that happens, or we're likely to be into a lot of trouble.
Yeah, I certainly agree, and I think it is something that's been gravely overlooked by the majority of the market's participants. So you really are of the opinion that the Japanese Ministry of Finance and Greater Japan Inc. will sell their holdings of U.S. dollar-denominated treasuries and other overseas assets in order to finance their reconstruction as opposed to breaking out the printing presses?
I don't know that they'll necessarily sell existing assets, but I'm quite certain they won't be buying any more.
Haven't their trade balance already been impacted enough? I haven't seen numbers because the event was so recent that would give us a view with regard to the international capital flows between the United States and Japan. But I would think that that would have had enough of an impact given the JIT, just-in-time delivery impacts and other aspects, that it should have significant adverse impact on the international capital flows.
Well, it's already happened to some degree. Toyota's no longer the number one car producer in the world. And that's just simply because they can't make any cars. They don't have any electricity to run their factories with. They will fix that over time. But the larger question is exactly what is the extent of the damage? And everyone's been focused on these reactors. The reactors are small potatoes in the grand scheme of things. I mean, it's terrible if you happen to, own property within, the 100 square mile boundary around the plant, obviously. But in terms of the actual damage to the economy, you got to look at this from the perspective of the fact that there's upwards of 15,000 people who died in the tsunami. And those people were killed, and all of the productive infrastructure that went along with the land mass that was inundated by salt water has been destroyed. And that's all going to have to be rebuilt. So, when we look at the disruption now, it pales compared to what's going to happen. When these capital flows start to come back into the country, it's going to be substantial. It's essentially like having, 20 Katrinas all at once. And, the United States having to rebuild, the 400 miles of seaboard as opposed to one city.
Yeah. Okay. Um, so let me try to take things back a little ways away from Japan and back to the United States. From listening to you this evening and from reading a number of your blog posts, I get the distinct impression that you believe that there will be an asset and debt deflation here in the United States as bad debts are written off, financial leverage is backed out of the system, and as fiscal restraint is once again restored to government budgets and finance. Why do you think that this must occur as opposed to slowly inflating away the debt problems?
Well, primarily because you can't slowly inflate away the debt problems. Uh, we have $53 trillion in the system right now in outstanding credit, which is, of course, debt to the person on the other side. The sustainable level of that in the economy, given our GDP and given historical norms, is about 50% of what is currently present, so somewhere in the $25 to $27 trillion range. The idea that we can somehow inflate away $27 trillion with a $2 trillion monetary base is laughable. If we were to actually attempt to do something like that, the dollar, which currently is trading at around 74, would trade at 7. The cost of gasoline would be $30 a gallon. A gallon of milk would be $40. Long before you got anywhere close to that, essentially everything in society would collapse. The middle class and below, the bottom two quartiles of the American economy, or if you prefer, the bottom two quintiles, if you want to be a little more precise, because the guys that are absolutely in the middle probably survive this. But the two bottom quintiles would literally be gone. And by gone, I mean starved to death and food and or rotting in the street. You've already got a huge percentage of this country that lives hand to mouth and is having a great deal of difficulty absorbing what's going on at the present time. You take a look at the jobless claims data started to move back upwards. It's back over 400,000 again, second week in a row. And that's very clearly occurring because of what you're seeing in the commodity ramp. At some point, if you've got a minimum wage job and you live 40 miles away from it, it's not worth it for you to get in the car and go. And it's just, you don't make enough to pay for the gasoline. And it's, these kinds of squeezes happen. And we have a very large percentage of our population. Remember, the median household income in this country is only about $50,000 a year. There are an awful lot of people that simply cannot afford these kinds of hits. And not only are they getting squeezed on the commodity side, but state and local governments are actually increasing tax burdens. If your house used to be worth $400,000 and you had property taxes of, $3,000, now your house is worth $200,000, but your property taxes are still $3,000. Your effective tax burden has doubled.
Yeah, it certainly is not going to be fun as we take this next leg down. You recently put up a blog post that clearly indicated that there's a linkage between the relative currency valuations and key commodities prices, especially vis-a-vis the U.S. dollar. Our next couple of questions will be coming to you from this area. Currencies and commodity prices. First up, Thor, would you like to pose a question to Karl?
Sure. Are there any currencies that you believe are low risk and can serve as a safe haven for wealth preservation?
As an investment, no. As a place to speculatively or on a relatively short time frame move money around into, perhaps. One of the currencies that's been performing quite well would be to take a look at things from a standpoint of